Imagine losing your entire savings not because the market collapsed, but because of a single beginner mistake no one ever warned you about. What's even more alarming is that millions of new investors are making these same mistakes right now without realizing the consequences. If you're just beginning your investing journey, this video could help you avoid costly mistakes and save you years of regret. Most people think investing is complicated. They think you need to be a genius, a finance expert, or someone born rich. But the truth is, investing is actually simple. What destroys most beginners isn't lack of intelligence, it's emotions, ego, impatience, and tiny mistakes that quietly grow into financial disasters. And here's the worst part. Most new investors don't even realize they're making these mistakes until it's too late. So in this video, we're going to break down the biggest mistakes new investors make, why do they happen psychologically, and how you can avoid them before they cost you money, confidence, and years of progress. And trust me, mistake number 5 is the one that silently destroys more futures than market crashes ever could. Let's begin. Investing. Without understanding anything. Everybody's buying it, so I should too. This is how countless financial disasters begin. A friend tells you about a hot stock. A YouTuber promises the next Bitcoin. Social media screams, buy now before it's too late. And suddenly, people invest money into companies they don't understand, industries they've never researched, and trends they barely know anything about. Why? Because humans fear being left behind. Psychologists call this FOMO, fear of missing out. And FOMO is incredibly dangerous in investing, because when emotion enters, logic exits. During every major financial bubble in history, people weren't investing based on knowledge. They were investing based on excitement. The dot-com crash, crypto hype, meme stocks, different decade, same psychology. Here's the truth most beginners need to hear. If you don't understand how something makes money, you shouldn't invest in it. Simple. Warren Buffett once said, "Risk comes from not knowing what you're doing." And that line alone has saved people millions. Before investing in anything, ask yourself, what does this company actually do? How does it earn money? Why could it grow in the future? What risks exist? If you cannot answer these questions, you are not investing. You are gambling, trying to get rich, fast. This is probably the biggest trap on the internet. Everybody wants fast money, fast success, fast results, fast freedom. And social media made it worse. You see teenagers showing luxury cars, people claiming they turned $500 into $100,000 overnight. Financial gurus promising unrealistic returns. But what they don't show you is the losses, the debt, the failed trades, the emotional breakdowns. Because slow success doesn't go viral. But slow success is usually the real success. The greatest investors in history didn't become wealthy overnight. They became wealthy through consistency, compounding, patience. Imagine planting a tree. You don't scream at it every day, asking why it isn't 20 feet tall yet. You water it, protect it, give it time. Investing works the same way. The market rewards patience more than intelligence. And this is where beginners destroy themselves. They chase penny stocks, risky options, hype coins, unrealistic returns. And eventually, one bad decision wipes them out. Listen carefully. If someone promises guaranteed fast money, you are usually the product. Real investing is boring sometimes, and boring is good, because boring builds wealth. Investing with emotion. Instead of logic. Imagine this. The market crashes, red numbers everywhere. News headlines scream, "Market's in panic." And suddenly, beginners do the worst possible thing. They panic sell. Not because the investment changed, but because their emotions did. This is one of the biggest psychological mistakes investors make. They buy when prices are high because everyone feels excited. And they sell when prices are low because everyone feels afraid. Which means they literally do the opposite of what successful investors. Great investors understand something powerful. The market is emotional. You don't have to be. Fear and greed control most people. And the stock market exposes human psychology every single day. That's why discipline matters more than prediction. You do not need to predict every market movement. You need to avoid emotional decisions. Here's a powerful rule. Never make investment decisions when you're experiencing extreme emotions. Not during panic, not during excitement, not during hype, because temporary emotions create permanent financial mistakes. Not diversifying. A beginner finally decides to invest. Great. But then they put all their money into one stock, one crypto, one company, one idea. And if that investment collapses, everything disappears. This is called a lack of diversification, and it destroys beginners constantly. Think of diversification like building multiple safety nets. If one investment fails, others can protect you. Even professional investors diversify, because nobody can predict the future perfectly, not even experts. And yet beginners often become overconfident after one successful investment. That confidence becomes arrogance, and arrogance in investing is expensive. There's an important psychological phenomenon called confirmation bias. Once people believe something will succeed, they ignore warning signs. They only listen to information that supports their beliefs. And suddenly, a bad investment becomes an emotional attachment. That's dangerous. Never fall in love with investments. Numbers don't care about your feelings. Investing money. They can't afford to lose. This mistake ruins lives, not portfolios, lives. Some beginners invest rent money, emergency savings, loan money, even borrowed money. Why? Because they feel pressure to make it. But investing with desperation changes everything psychologically. When you need money urgently, you become emotional, fearful, impulsive. And emotional investors usually make terrible decisions. This is why emergency funds matter first. Before investing aggressively, build stability, because investing should create peace, not panic. Read that again. Investing should create freedom, not anxiety. If losing your investment would destroy your life, you invested too much. The market always moves unpredictably. Always. And beginners underestimate risk because social media glorifies rewards. But mature investors respect risk more than profits. That mindset changes everything. Constantly checking the market. This one is sneaky. You invest money. Then suddenly, you check your portfolio 20 times a day. Every price movement affects your mood. Up 3%? You feel like a genius. Down 5%? Your entire day is ruined. This obsession creates emotional exhaustion. And ironically, the more beginners watch the market, the worse decisions they make. Why? Because short-term noise creates long-term confusion. Markets move constantly. That's normal. But beginners mistake movement for danger. Long-term investing requires emotional distance. Sometimes the best thing you can do is nothing. And that's hard, because humans feel the need to act. But in investing, unnecessary action is often the enemy. Patience feels unproductive, but patience is where wealth grows. Not investing. At all. Now, here's the final mistake. And honestly, this may be the most dangerous one of all. Some people become so afraid of making mistakes that they never start investing. Ever. They spend years waiting for the perfect time. But the perfect time never comes. They overthink, delay, hesitate, and slowly. Inflation eats their money while time slips away. Here's the truth. You do not need to be perfect to start investing. You just need to start intelligently. Because time is the greatest advantage investors have. Even small investments grow massively over decades. But you cannot benefit from compounding if you never begin. The biggest risk isn't always losing money. Sometimes, the biggest risk is wasting years doing nothing. The powerful truth about investing. At its core, investing is not just about money, it's about behavior. The market tests your patience, your discipline, your emotions, your mindset. And most beginners lose not because the market beats them, but because they beat themselves. They panic, they chase hype, they act emotionally, they seek shortcuts. But wealth rarely comes from shortcuts. It comes from consistency, quiet discipline, long-term thinking, and the ability to stay calm while everyone else loses control. That is the real secret. Not some magical stock, not some hidden strategy, but mastering yourself. Because the greatest investor you'll ever become depends on the person you become emotionally. So let's quickly remember the biggest mistakes new investors make. Investing without understanding. Chasing quick money. Making emotional decisions. Not diversifying. Obsessing over short-term movements and never starting at all. Avoid these mistakes, and you'll already be ahead of millions of people. Because successful investing is less about being brilliant and more about avoiding stupidity consistently. Small, smart decisions repeated over time create extraordinary results. If this video helped you, make sure to hit the like button and subscribe for more videos on money, mindset, and self-growth. And in the comments, tell me, what's the biggest investing mistake you think people make today? I'd love to read your thoughts. And until next time, invest wisely. Think long-term. And never let emotions control your future.